Hi, I'm Jared Nelson from the Investing Channel, and welcome to The Spill. Google reported earnings after Tuesday's close that were phenomenal, and shares shot up almost 10% the following day as the company announced a long-awaited 20-for-1 stock split. You might remember Apple and Tesla shares running hard from the time they announced their stock splits and the event. We expect Google to experience similar price action. That's in part because the lower share price now makes it tradable for retail investors. And we know they're interested because of the surge in interest we can see in our proprietary search data this week. But once the dust settles, do the company's fundamentals justify its lofty price? Well, let's start by looking at what made Q4 such a big deal for Google. For starters, total revenues for the company climbed 41% compared to 2020, with every category hitting double-digit growth. In fact, search, YouTube, and cloud all rose by more than 40%. The worst performing segment was Other Bets, which only grew at 15%. Total cash provided by operations jumped by a whopping 40.7%, though as a percentage of revenue dropped from 35.7% to 35.5%. While long-term debt did increase from $13.9 billion to $14.8 billion, that's peanuts compared to the amount of cash the company generates. Not to mention the nearly $140 billion in cash the company keeps on hand. To give you an idea, that works out to $205.37 a share, or 6.8% of the current share price. Now a quick look at valuations. And with 2021 in the books, Google closed out the year with earnings per share of $112.20, giving it a price-to-earnings ratio of 26 to 7x. While that might seem high, consider that 2020's earnings per share was $58.61. The growth rates Google is hitting are so high that the price-to-earnings ratio looks incredibly cheap. Forward estimates put 2023's earnings per share at $132.49, or 18%, and revenues up 15.71%, which we think may be understated on both accounts. Frankly, a company of Google's size shouldn't be able to hit these kinds of growth rates. And yet, it has an incredible amount of runway in cloud alone. Plus, the company generates $91.65 billion in operating cash annually, or $134.78 per share, giving them a price-to-cash flow ratio of a bit more than 22x. Considering that cash jumped by more than 40% in the last year, this is still a fantastic value. So, in our opinion, this is a 10 out of 10 ranking stock. We expect shares to climb up into the stock split. But even afterward, Google has an incredible business with so many potential profit avenues, it's easy to see why analysts love this stock. Click and subscribe to the Spill newsletter to get the full breakdown.